hold concept. So what I'm going to do is I'm going to walk you through a couple of different components here. And we're going to talk about some of the things that we need to unlearn in order to make VPM work from our mental framework. These are the things that we're actually going to be communicating with clients too. So I have a new way of thinking. We're not going to be looking at yesterday, at least not the same way. Now, we actually know this. We have seen this on just about every piece of literature that we have ever tried to push through compliance. And what is it? Past performance is no guarantee of future results. But for whatever reason, the MPT crowd loves to drive using the rearview mirror, which works pretty well until there's a corner. So here's what I want us to do. I want us to start thinking a little bit differently because we are putting on a new hat. When using VPM, we're not just financial advisors, we are money managers. So as a money manager, we got to ask a different question. If I knew nothing about the past in regard to any particular position that I'm investing in, would I still own this position today? Think about it for a second. Would I still own it today? Now, as a risk manager, and this is something that I would point out to all of you when marketing in your practice, there are money managers, but I think that the more powerful statement to our clients is that we are not just money managers, we are risk managers. And as a risk manager, what should I ask myself? Does VPM own the position? What we're going to cover, I'm going to call the 7 myths that we need to bust about MPT. Now, I'm kind of a Discovery Channel junkie. And there is a program on the Discovery Channel called Mythbusters. A couple of crazy wingnut guys that take folklore, myth, whatever it is, and then they literally go out and see whether or not the myth is accurate. And so if the myth is accurate, it's confirmed. If it's not, it's busted. And I'm going to take you through these 7 myths about MPT. First, you can't time the market. Where did this rumor come from? Now, I'm not a big conspiracy theory guy, but I have to believe that somebody gets paid if we leave the money invested with them. And why is it when I look at a mutual fund, I can see turnover? Somebody's timing the market. Every buy or sell decision is a form of timing the market. So from the very get-go, we've been told, oh, you can't time the market. We never do that. Well, I don't think that we're trying to time the market. I think we're going to try to trend the market. We've got the wrong perception of what timing means. We somehow get the impression that timing means that we got to get it perfect. We got to get in at the top and we got to get in at the bottom. I suspect that this is one of the reasons that many of us fight with the trading models. Why haven't we sold EFA yet? Right? Because we're so busy trying to get it perfect. And it's not about getting it perfect. It's about getting it mostly right most of the time. And that's one of my favorite phrases. Most of you have probably heard me say it before. We don't have to get it perfect. We got to get it mostly right most of the time. March that forward over time, and it's a recipe for success. We're talking about scaling risk in a portfolio, right? Moving into or out of positions based on large trends in the market. That's why we're using weekly trends primarily. We don't even use the daily models, most of us here. We're looking at trending environments. I'm going to go ahead and call the first myth busted. We have the tools to manage the money. We've been told just simply that we weren't smart enough to do it. And again, part of the reason we were told that is because somebody else gets paid if we send them the money. So we want to take control of our practices, get this process under our belt so that we can deliver value and we can be properly compensated for it. We're going to get rid of the idea that we can't possibly make buy and sell decisions in our investments. Let's look at myth number 2. And this one is probably one of my favorites. I'm going to show you the other side of a very dirty secret in the industry. If I miss only a handful of positive days in the market, my investment returns will plummet. How many people have heard this rumor? More than a few hands. All right, let me frame this. This is taken from an article out of the Financial Planning Journey written in 2005. So this is not exactly new information. Okay? And the evidence was taken from January 1984 to December 1998. 15-year period in the market. Over that period of time, we all know, as memory serves, and granted, this does not include the last decade, that was a pretty substantial bull market. In fact, the market's averaged 17.89% annualized return on the S&P. What would happen if we missed the 10 best days in the market? Our return dropped from 17.89 to 14.24%. On a percentage basis, that's what, about a 15-20% decline, relatively speaking, from 18 down to 14. If we missed 20 days, and I guess I should have probably told you, there's roughly 3,750 trading days over this period of time. 10 days represents less than 0.2% of those days. So if we missed 10 of them, our returns dropped by 3.5%, almost 4%. If we missed 20 of those days, we dropped to 12. If we missed 40, we were cutting our return in half. What are we never told? What if you missed the worst days? If you missed the worst days in the market, just 10 of them, your return goes from 17.89 to 24.17. Better deal. Missing all 40 of the lousy days, your return would have been almost double, 31.66%. Now, I got to point something out because a lot of folks don't realize. This study that I'm referencing also talked about the sequence of returns. Did you know that the biggest up and down days in the market typically occur in very close proximity to each other, within a period of usually a few days? But there's no correlation as to which comes first. Does the big day come followed by a big down day, or the other way around? I find it kind of interesting that we were down 300 and some odd points yesterday and up 125 or so points today on the Dow. I mean, we're seeing the volatility, big days down followed by big days up. Here's the part that's really interesting to me, though. What if we missed the best and the worst days? Our marginal return goes up. We actually go from 17.89% to 20.31. And what's particularly compelling to me is it didn't matter if we missed 10 days or we missed 40 on both sides. So we could have missed 20 days, right? 10 good, 10 bad. Or we could have missed 40 good, 40 bad over that 15-year period, 3,700 days. If we'd have been able to time that, our return barely changed. 20.31, 20.87. We're talking about what, 56 basis points there? That is not a dramatic difference. Here's the dirty secret. Low volatility portfolios, given similar sequence of return, makes more money. We preserve our ability to compound. We got to figure out a better way to communicate this to our clients. So I'm going to bust this myth. Myth number 2, that missing the 10 best days in the market is going to somehow torpedo our returns. It's not about the 10 best days in the market. It's about volatility in our portfolios. Risk management matters. Myth number 3, asset allocation weightings should reflect historical volatility, performance, range of return, and risk-reward metrics. All of the MPT statistics that we have grown up on, that we would somehow look in the rearview mirror, see how this asset class has performed, and come up with a weighting to this asset class, right? We have to have low correlation assets. We need to be broadly diversified. And the idea is that we could somehow, using this mythical efficient frontier, plot a point that would maximize our return per unit of risk that we take. The problem is, the efficient frontier moves all the time. The historical performance metrics change. Economic circumstances change. I mean, we've talked about in this very conference, people have said, Bob, you were pretty bullish in the commentary back in April. What happened? I said, well, take a look at Europe. You know, times change. And so having a process that can adapt versus a product that's static, you know, we're looking in the rearview mirror, we've got no way to adapt. Now, we've tried to solve this problem through tactical allocation, right? How many people tried tactical allocation? Yeah, a few hands there too. Everybody's just shy, but most of you have tried tactical allocation. I have. I'm guilty. Well, now we're just trying to predict where the puck's going. The problem with that, again, we still end up biasing. I mean, I can't tell you how many portfolios, how many people in 2008 were over-biased to large cap growth or value. I mean, we got hurt by it. We had no exit strategy. It hurt. So, and in fact, let me point out one other thing, the efficient frontier. How many people have ever seen some of the research that Ridex has done? The efficient frontier at different points in time moves all over the place. It's not a static frontier. There's no optimum mix of equity versus fixed income. It's all over the board. So I don't think that past performance is indicative of where the future is going. We write it all over our reports, and then what do? We turn around and we try to use that as our guide for application. The elephant in the room. MPT statistics and asset correlation. We all tried to use it. What happened in 2007 going into 2008? Allocation across the board goes to 1 and everything falls. I mean, it didn't matter where you were. There was no safe port in the storm. Delivering a marketing message, you're trying to communicate value to your clients. In 2009, the problem didn't go away. We just had a rising tide lift all boats. Everything went up in 2009. It didn't take any brains. A monkey could have done it. And those of you with a VPM process, you did. I don't know how many of your peers could say the same. You know, after being bludgeoned by the market for however many months it had been, it was pretty hard to make the call to get back in the market. Not having a process, that's one of those dangers. 2009, the correlation problem never went away. It's not like MPT was mythically fixed. We didn't even get bailed out. Most of these portfolios aren't even back to even if they were in a buy and hold strategy. Right? They're still underwater. I'm going to point out one other anecdotal piece. And this is, again, a marketing component I would bring out. We saw the market respond quickly. Our market is very, very clever about producing products that meet a market need. We saw the creation of all kinds of bizarre, non-correlated assets, right? Managed futures show up. We see new absolute return funds, 10-30-30 funds. We've got long shorts. We've got all these different ETF companies beating the door to the market with different, inverse strategies. I mean, the market was doing whatever it could to produce some kind of non-correlated environment so we could put us back into the MPT box, right? I mean, we were trying hard. The truth of the matter is, it hasn't ever worked. You get a 15-year bull market, you think that MPT was working. It's never worked. You were just bailed out by a rising tide. What's VPM going to do that's different? It's going to scale in and out of the market. It's going to give us a sell-side discipline. It is radically different from MPT. And we got to communicate this to our clients. We have a sell discipline. We manage risk. We don't forget about it. We don't sweep it under the carpet. All right, next myth. Portfolio assets should be low or non-correlated to reduce risk. This is a weird one. Now, I'm going to challenge your thinking on this, and I'm not doing it because I'm going to advise you to go out there and look for a bunch of correlated assets. That's not the point. The point is this is a holdover from MPT, and we got to understand what we're dealing with. Okay? If assets are all correlated and we put it into a modern portfolio theory environment, everything falls, we have a problem, right? So we try to produce a bunch of different components with the thinking being not everything could possibly fall at once. The truth of the matter is VPM doesn't care if something's correlated. Okay? Well, you could actually go out and pick a bunch of tech stocks, a bunch of oil stocks, doesn't matter, because VPM it's got a sell discipline. But there's a big but, okay? So we could go out there and we could pick a bunch of assets, all correlated, a bunch of oil stocks. If the oil stocks aren't working, VPM's going to keep us out. We still have a defense strategy. We got no offense. If we guess wrong, this is the big but, if you don't diversify into multiple asset classes, you better be a really good shot, because the one bullet that you pull has to be right. When you diversify, you're giving yourself more opportunity to capture assets that are on the rise. And that's the point of diversification in these strategies. VPM is still a buy and sell discipline. It's an allocation discipline. And I like the translation because it's simple. Look, if you bet on all the wrong horses, when you're using VPM, you may not lose, but you can't win. Right? I mean, if you bet on bad horses, you can't win. But at least VPM can keep you from losing. That's the trick. Correlation isn't particularly relevant in the strategy. When you hear people talking about, oh, well, we need a non-correlated asset to throw in here, it's not how VPM thinks. You're trapped in the MPT world. That's just not how it works, guys. So myth 4 busted. Asset correlation isn't relative to VPM portfolio. A buy and sell discipline is going to handle that for us. But the odds are certainly better if we have a diversified strategy. Next myth. This is my chance to beat people over the head. Cash is not an asset? Well, it's certainly an asset. And Cash is just really conservative fixed income, right? I mean, we've seen forever cash and cash equivalents. Any financial plan, you always got your little piece of the pie there. The part that folks, I think, they misunderstand is dealing with dynamic risk management. Dynamic exposure to fixed income, right? We're scaling in, we're scaling out. Constantly changing the risk exposure. Do a compliance component in a second. We're going to talk about this a little bit. But I just want to beat you over the head. Cash is fixed income. Now, if you have clients that ever come to you, and I got to know, because I've had this problem. You're sitting on a bunch of cash, maybe it's late 2008, early 2009. You have a client that comes to you and says, well, maybe we should put that in a CD or something. Anybody ever had that happen? Okay, this is a marketing opportunity. I'm going to tell a little story. I was at a conference about a month ago, and one of the folks up here, so he's up there and he's talking about going on a drive with, I believe it was his mother-in-law, but she's just complaining about the traffic, about the stoplights hitting every light, about the road construction everywhere, and finally gets really frustrated with her and says, enough of this complaining. Look, from now on, they're not stoplights, they're go lights, and it's not road construction, we're building roads to prosperity. And I chuckle about it. I say, this is all the way we frame this. If our clients struggle with cash, call it something different. For my clients, we call this our opportunity account. Okay, because we're waiting for our next opportunity to go out there and add alpha. If you have trouble, marketing point, and remember, it's all about language. Bob's talked about this. Opportunity account. Cash is an asset, preserves our future opportunity. Now, next myth, investors fit in a box. We're going to get into a compliance component that a lot of folks ask me about. For whatever reason, the industry is built around the concept that a client walks in, we test them on a risk profile, we end up with some kind of categorical reference to how much risk they're allowed to take, and our compliance department assigns a ratio in the back office that says they need to have about this much fixed income and this much equity based on their risk profile. I mean, this is the way our world is built. Every person here that's using VPM, we are fighting against the current on this. FINRA's built it this way. Our compliance departments, they ratchet down even tighter because they want to make sure that if FINRA is going to come looking for it, then we got to do even a little more so that we're under the radar. Our peers do it. Not in this room, but we know lots of other advisors that are still clinging, the whole Nick Murray concept. We've got MPT and the history of it itself. And for heaven's sake, it's won a Nobel Prize. Never mind the fact that it was in 1952, when markets didn't trade 24 hours a day, when you didn't have online brokers, the market wasn't globalized, and we had less volume in a year than we have in a day on a single position. Now, do you think the market dynamic's different? We trade more shares in the SPY in a day than we traded in the entire market in 1952. All right, and frankly, the other component that we keep hearing about, institutional models. How many people have heard about the mythical Yale Endowment Fund? I don't have $36 billion in one account to go out and buy timberland as a non-correlated asset and sit on it for 60 years. And even if I did, I don't know that it's the best idea. They're using the old institutional thought process. This is a really big concept that I want to share with everybody that I think is mission critical in appropriately communicating VPM to your clients and to your compliance department. This is the magic of or less. The or less statement that we scale into or out of risk. Now, you have probably heard us at some point talk about blending models together, having, say, ETF DI and bond DI, a fixed income and an equity strategy. Maybe satellite gets mixed in there too. But the idea behind this is our compliance department is still going to apply the old rules. Just because we play by different rules doesn't mean they do. So we got to figure out how we're going to fit in their world so that we're not finding ourselves constantly being barraged by our compliance officers. The or less concept is simply like it sounds. If I were to take a client and do the traditional risk profile, they come in somewhere in the growth category here. I'm willing to take up to this much risk or less. They're not stuck in this boundary. Scale all the way to cash, we can scale all the way back in. We can assure our compliance department they will never go more than 80-20. How do we do it? We have a fixed income account that we take. Let's say we got a $500,000 account. We take $100,000 of it, we put that in bond DI, we run $400,000 in ETF DI. Bond DI will never own equities. So we know 20% of the portfolio will never own equities. The other 80% can go full equity, can go full cash. We can go or less, but we can't go more. The way you address this with your compliance department is through a quality investment policy statement. Define it. Have your clients sign it. Authorize the fact that they understand it. I am coming in with a risk tolerance somewhere on this spectrum, just like we've always used. But when your compliance officer calls and says, wait a minute, why are you outside of the box? You can say, the client's aware, they have authorized an or less strategy. We will not take any more risk than this, but depending on the market environment, we'll take less. The client's got an investment policy statement that defines it. The compliance officer that's calling gets a fax of that statement. And at the very worst case scenario, what I've seen happen is they put a 6-month recall on that particular problem. In 6 months, they come back and they see, where are you in the box now? And for most of us, 6 months is enough time that that's going to change. If you're in a fee-based environment where they're looking at activity, you're going to see activity. It's what the compliance officer is looking for. So it does solve the problem, but it also helps us communicate with our clients. What are we doing? We're scaling in and out of risk. And this is how we do it. Okay, so we don't put investors in a box. We put them in a range. So myth 6 busted. Last myth, buy and hold. It looks like it works. A rising tide lifts all boats. But the truth of the matter is the last 10 years are proof in the pudding. We've seen more wealth destruction in the last 10 years than most of us care to discuss. If we look at the S&P 500 in a buy and hold environment, we're underwater. We've had 2 major pullbacks in the 2000 to 2002 market and in the 2008 market. 2 substantial destructive environments where buy and hold simply didn't work. Most of us are not dealing with institutions. We're dealing with real people and real money. They're not pensions and they're not endowments. They don't have the luxury of saying, like Yale does, we're off 40%. Well, let's just give out 40% fewer scholarships. Right? Their distribution's not going to change on a retirement account. Our clients, these real people, they can't afford to have catastrophic losses in their accounts. This is real money. Having a risk management strategy matters. And the last 10 years is very, very evident. So what I'm going to do is I'm going to call this myth busted, and I'm going to move on to what was originally the marketing component. I'm going to try to pull some of these things together. And then what we're going to do is we're going to bring up a group of peers from you all, and we're going to hear some stories about how they have successfully been marketing in their practices.